All right, before we get into some of the more specifics related to accounting, let's talk about some of the accounting basics. We're going to talk about what is accounting. So you'll learn kind of from a definitional standpoint, when we talk about the term accounting, what do we mean? And then we're going to go into the two types of accounting that you commonly see, and we call these financial and managerial. We'll talk about the difference between the two, as well as some of the different things that are reported under both methods of accounting. So to start off, accounting really is a system for doing several things. It's a system for recognizing, organizing, analyzing, and reporting a firm's financial information. You see, businesses produce a variety of different types of financial information, and unfortunately, those types of transactions and things aren't inherently valuable, and it's difficult to really infer what the significance of. And so what accounting does is, it does a couple of different things. The first thing is it recognizes when financial transactions take place. And so when someone goes into a particular store and conducts a transaction, whether it's purchasing a product or a service, accounting establishes the systems to recognize those particular transactions that are taking place. Because as a business, we want to capture that information so that we can, of course, analyze it, and we can determine, whether or not a particular establishment is achieving sales goals and those types of things. And so we use accounting information to make those decisions. The next component or next area or purpose of accounting is to organize said information. Unfortunately, accounting or a lot of information is produced by businesses over the course of operating, whether that would be something like sales information, or it could be even something on a more kind of detailed level where it's employee productivity and hours worked and those types of things. And accounting provides not only the ability to recognize the information itself, but also organize it in a way that's inherently useful. So instead of having kind of this collection of data and having to sift through it and those sorts of things, accounting gives us the ability to organize information based upon kind of the driving factor behind it. So organizing sales information specific to products, organizing sales information based upon date or month, kind of that duration or period of time. And even organizing information going back to employee hours. So based upon the hours that a particular employee works and making sure that we categorize those somewhat accurately. The next component that accounting provides is analyzing. And analyzing is a really big component because it's easy to produce the financial information. You all are probably familiar with some of these different tools that can be used to really make kind of the bookkeeping aspect of accounting rather simple, and using things like QuickBooks and Quicken and other software that have really made this process rather simple. You can, of course, entering your financial transactions, which is pretty simple. You have kind of a ledger, and then with a click of a few mouse clicks, you can run different types of reports and really categorize the information and organize it. So if you're looking for information for one particular payee, you can certainly find that. That may not be inherently valuable. What is valuable from accounting is this analyzing aspect, and it is looking at the data and it's deriving meaning from the data. And that's a very, very difficult thing. And that's where accountants provide a lot of value. We can outsource the bookkeeping aspect and really automate that with software. But what's difficult to do is to analyze the information and to determine really what it means and what the significance of it is. And that's a really important aspect of accounting. The last aspect is reporting. And reporting is essentially producing those types of financial statements that we'll talk about here in a few minutes. So accounting, of course, is very valuable. We've talked about kind of the objectives and the purpose of accounting. Let's talk about the two different types of accounting. So we can group those into two different categories. First, we have financial accounting, and then, of course, we have managerial accounting. Now, financial accounting is accounting that is meant for a particular group specifically, and that is what we call external stakeholders. And an external stakeholder, you probably kind of get the idea of the concept of a stakeholder being someone that has an interest in the operations of a company. External meaning that they are outside of the company typically, so they don't work within the company. So common examples of an external stakeholder would be people like investors, most commonly. Can include regulators, can include suppliers, anyone else that is outside of the company that has some kind of interest in monitoring the performance or the behavior of the company itself. And as external stakeholders, our needs are very different than someone who works with the company. And so what we're looking for is kind of a higher level overview of the operations. We're not necessarily worried about the productivity of one small department, or, whether or not, one department was able to meet their payroll numbers. That kind of stuff doesn't really mean a whole lot to us. Now, to a manager of that department, that data is very meaningful because they're going to use that to, make decisions and make changes based upon hiring and based upon who's working and those sorts of things. But for an investor, we don't necessarily care about, the weeds, so to speak. We're more of looking at the giant overview, kind of the trees. So for an investor, we're more worried about things like revenues and profits and the assets that are obtained by the company and the cash flow of the company. So we want different types of information. We don't need the very granular data, but we need kind of the broad strokes. Give me a highlight, give me an overview of the performance of the company. So under financial accounting, you'll see kind of three big financial statements, and we'll talk about those in future videos. You'll see a balance sheet, an income statement, and a statement of cash flows. And those are by far the three most important financial statements that are produced under financial accounting. Now, managerial accounting focuses on the needs of, obviously, the internal stakeholder. And the exact opposite here, where an external stakeholder is someone who resides outside of the company that has an interest in how the company behaves. An internal stakeholder is an individual who resides within the company, so works within the company, and of course has an interest in the success of that firm. So an internal stakeholder, common examples are going to be your employees and are going to be managers. And there is a much different type of information, or data rather, that is important at this level, right? You're looking at things like costs, specifically. So if you run a particular department and you're working on a product, you're really interested in the costs associated with the product, and so you're going to be very curious as to every single cost that is going into that product. Whether it be, production costs or materials or really anything, you're looking at things on a much more specific level. And so managerial accounting is primarily for the needs of internal stakeholders, whereas financial accounting is made primarily for the needs of external stakeholders.